In a world brimming with challenges and change, with crises all around us, we need ideas, innovation, and inspiration. Welcome to the Free Market Roadshow 2024, where the pulse of contemporary discussions beats.
I kindly ask Barbara Kolm, Vice Director at the Austrian Central Bank, to give us a few introductory remarks and go on to the presentation of Keep Politics Out of Monetary Policy. Thank you.
So, welcome back to the second session, and I simply would like to thank our partners and organizers that we were able to pull this off again and to have the great tour in Zagreb again. And as was mentioned before, Croatia is not only one of the most beautiful countries and livable countries, it also has the most beautiful coast. So it is definitely an incentive to study here. You are also international students, and I think it is great to have those. And talking about international students, I would like to introduce you to two ladies here, Daria and Anastasia, who came from Ukraine and are staying here as our guests because they won a wonderful competition, an essay competition that was run by Mannkal, by our friend Ron Manners from Australia, about how Ukraine can recover and what kind of solutions are there. And the two ladies were two of the five winners. Unfortunately, the gentleman could not make it, was not allowed to leave the country, and the other two ladies could not make it because of their studies. But here we have Daria and Anastasia. Could you please come here for a second? And briefly tell us what you wrote about.
So, hi everyone. I'm going to start. My name is Daria, as it was announced. And my essay, my work was on management. As it's my field of expertise and I put my whole soul into this work, I started with a simple yet controversial thing that in order to make a company or an industry thrive, we have to make sure that we have a sufficient level of management in it, and the same is applied to the economy. In Ukraine, we have two main problems of management in the whole system of Ukraine. First is the lack of consideration of management on a legal level, and second, which is a rather ambiguous thing, is a conservative mindset of the citizens towards management. In terms of the first one, I suggested some solutions, how we can change the legislation, for instance, implementing a law about professionalization of management and creating such an organization as the National Committee of Management, which will be in charge of all of the governmental decisions in the field of management. And then switching to the other topic, which is the mindset of the citizens, it is rather controversial since it has its basis from the historical point of view. But led by the laws and led by the global integration and global switch to the correct mindset, I believe that evolutionary will switch to the correct mindset, correct mentality in terms of management. I want to wrap it up and give an opportunity to speak to my colleague Anastasia by saying that it's all up to us, and I really believe that in future, with our support, with the support of our generation and the government, of course, we'll have the correct state of management. Thank you.
Good day. My name is Anastasia. I stage in Odessa State Agrarian University. Today is the most pressing problems of humanity in the reconstruction of post-war Ukrainian. Therefore, it is necessary to develop plans for in reconstruction now. My essay tells about the explosion of the Kakhovka hydrical power plant and the plan to rebuild it and how important it is. Thank you.
As you can hear and see, one other thing I would like to point out, and then I immediately, if I may, go to my remarks, is Hayek's Road to Serfdom. It was mentioned before, but it's the 80th anniversary when Hayek wrote this important book where he warned us against central planning and against all forms of totalitarianism. And it's more than up to date, unfortunately. And in the past panel, we were discussing COVID and when our freedoms were taken away. And I can only tell you, we will only realize how important freedom is once it's gone. So it's up to us to constantly have that in our minds and constantly defend it. And without further ado, I quickly jump on onto our discussion now on my topic, which is keep politics out of monetary policy or out of central banking and other things. Why am I saying that? Well, there are certain things, certain developments that we have observed not only over the past 24 years, but we have seen we've had historical evidence why politics must be kept out of central banking or of monetary politics as well. And some people in the Austrian School of Economics go even so far as they say we don't even need a central bank. Let's do it differently. And Hayek was in the 70s was writing about competing currencies and about the importance of value, of a stable value. The term inflation was coined before in the last session, and I asked you students, why do you think we have inflation? What are the reasons? Have you heard about quantitative easing? Do you know what QE is? This is when the monetary base is just widened and broadened, and when the central banks start printing money. We've done that for a very long time in Europe as a response to the so-called grand financial crisis that had hit Europe in 2008, that came to Europe, but it was actually a sovereign debt crisis. And my dear colleague Neven will discuss the debt crisis later, so I will not focus much on that, but our governments definitely have spent way too much money. They overspent it and used it, and now we have a huge debt level. And in order to refinance, or not only to refinance that, but in order to kind of keep going, we kicked the can down the road for a very long time, and we did that by printing a lot of money, by setting up government bonds, by the ECB, and this was called the so-called asset purchasing programs. That were started in 2012, 2013, with the amount of 1.8 billion at the beginning, and then we added up to a little bit more over those period of time, actually until 2022. Then another reason why we have inflation. So one reason is printing too much money. Second reason would be, for example, if prices don't match anymore on the markets, if supply and demand don't function. So we have another reason. The Green Deal was announced in 2017, 2018, and all of a sudden energy prices shot up. Why? Because companies could not adapt their technologies so fast as was needed when, the Green Deal was announced, that we have to change everything. I'm just giving an example of Germany moving from combustion engines to e-cars, and then by that you need a lot of technology, and there is a lag of technology, and then of course you need to adapt that, and so all of a sudden prices were disrupted, and energy price, in that case it was also energy prices, came up. Then came COVID. This was the third trigger for our big inflation, and this was actually the biggest problem, because that told us when supply chains are locked down, not only we were locked down and we were locked in, supply chains did not function anymore. The supply and demand, the price system did not work anymore, and if the price system doesn't work, then of course you also see inflation. The fourth and final trigger was then the war in Ukraine, or actually the Russian aggression to Ukraine, which also rose the gas prices in addition, and these spirals together with the pandemic emergency purchasing programs that were started by the European Central Bank led to this huge inflation. But I leave you with that now. Why I give you another reason why we want government out or politicians out of central banking, because there is a couple of not very good ideas. When the European Commission announced last year, 28th of June, they issued two documents. One was the use of cash in the European Union, and the other one was on central bank digital currencies. So central bank digital currencies, or the digital euro, doesn't have anything to do with private digital currencies, with private digital means of payment, like, you know, whether you use credit cards, whether you use one of the cryptocurrencies. I don't know who of you are familiar with that and who hold their cryptos or not, their bitcoins or whatever means of payment. But at least it was announced last year that the European Central Bank gets the go to have the European digital euro. So let's think about it. Why do we have cash still? Cash is, by the way, the only legal tender in Europe, or in the European Union, that is using the euro. So the euro in the Eurozone. So cash is simple. It's a final payment. If we exchange, you and I, it's done. The deal is done. Of course, it's anonymous, it's stowable everywhere, it's divisible, and of course it's robust, and of course independent from technical issues. If we have an issue with our grid, if electricity is down, for an example, then it would not. Then we would be happy to have we have cash. So, after all, cash is something important, and it's also the printed form of freedom and trust that we have in our societies. Well, the European Union thought, and the European Central Bank, under the excuse, or actually with the excuse that, you know, we need to push digitalization, that we also need a digital euro and reduce cash, the use of cash, because we have to make sure that terrorist acts are not financed as if they were financed with cash, or that fraud will be reduced. All those are reasons, good reasons for the European Union and the ECB to reduce the use of cash and to switch to a digital euro. But there is also one other reason why the ECB and also the European Union say that we need the so-called strategic autonomy, which means we need to be independent as a European Union, as users in the Eurozone, because so far we are dependent globally with regards to finance on the US, China on resources, Russia, still many countries on energy. But especially in the financial markets, we as Europeans are dependent on the US for transactions, because all the transactions are being done via the US, and for clearing from Great Britain, that unfortunately has left Europe, for us unfortunately. And so this is why the European Union thinks for strategic autonomy, we need to do that. However, what will the digital euro look like? And what does this have to do with our individual freedoms and with our data privacy and protection? So the digital euro, and by the way, we will most likely be after China, who is running the digital yuan in 8 provinces. But there is no other central bank so far that has used the digital currency. But we will most likely be the first ones in 2027 when Madame Lagarde has her say. that we will use this. So how will this look like? We will have accounts that will be either tokenized or that will be, and they will be most likely programmed. Of course, it's not officially said that it will be programmed yet, because negotiations are still taking, or discussions are still taking care. But who will use this this digital euro, and what would be the benefits from the angle of the central bank? So residents can use it, retailers can use it, authorities in all the euro area can use it, so authorities. Eurozone citizens in Eurozone countries, but also abroad, and foreigners with Eurozone accounts at banks in the euro area. So if I'm reading that to you now, or I'm telling you now, what difference is there to my private bank account, to my private credit card, to my private bank card that I'm using? Actually, there is no difference. So why would I then need a digital euro? To be honest, I have not found an answer yet that would explain it, because we have used MasterCard, Visa cards, whatever, Amex cards for the last 50 plus years. And I think it worked well. There is, however, an initiative on the European level from fintechs and private payment solution providers. However, not all countries in the Eurozone are members of that and are not working on that front. So there is a good reason for the ECB to push this. And I would say there are also some good reasons for IT guys and programmers to look into that. Because eventually, and we are not there, I'm stressing that we are not there yet, or hopefully never, but in China, the digital currency is tied to many things, positive and negative support. As Vedran mentioned before, maybe if she has an extra whatever bar of chocolate, she might have a minus in her social account, and she might not be able, if she has to pay with a digital euro, be able to buy it because some government is controlling that. Or not some government, but some anonymous power. So these are things that we should kind of keep in mind when we are discussing non-private payment solutions that can limit our individual freedom and can limit our action, ways of how we act. And there is just another question that is not discussed at all, because those payment and I'm stopping here now, those payments, if you use them and you have your digital euro account, most likely you will have a limit of 3,000 euros on your digital wallet. So if each and every citizen in the Eurozone, has a wallet and has 3,000 euros on there, what will banks do? What will their liquidity be? I mean, this question has not been answered yet, and this will be also a very difficult thing for the entire financial market, for the entire system, and for the stability of the system in order to function. So, summing up, the task of the central banks are actually monetary and price stability. Those two things, and nothing else. No green finance, no nothing, and. If they cannot stick to this mandate, and if they cannot solve this mandate, because if they did, we would not have had this inflation issues, then they should not start something else. And without further ado, I give my word back to our moderator. Thank you.
Now I kindly ask Neven Vidaković to present his topic, Debt is selling, but who is buying?
Before even I start, where's Barbara? You asked a question, you asked the wrong question. You said you couldn't find an answer. You should have asked Madame Lagarde, because Madame Lagarde explicitly said it is about control. So that's the answer to the digital euro. For those of you that are slightly older or younger, there's a movie called Ocean's 13. And in that movie, there's a great line. The guy says, "It's so nice to be working with proper villains again." Well, we're going to modify that, and we're going to say it's so nice to be working with proper outlaws again. You will find out why at the end. Sticking with the musical theme in my previous lectures, today we're going to focus on, the band is still around, but mid-80s death metal band called Megadeth. Their first album was "Peace is Selling, but Who's Buying?" So we're going to do the "Death is Selling, but Who's buying?" Okay. So here's what's been going on for the last couple of years. United States has been producing huge amounts of debt. And because of the time restrictions, we're going to focus more in the US, but it's exactly the same in Europe. And everything that's going to happen is going to be exactly the same as it is in Europe. So you see, United States has produced $11.8 trillion of debt in a span of, let's say, 4 years. Now, Fed has bought a significant portion of it, about 4.5, so let's say some slightly under 30%, but it's been selling it because we're now in QT, so the quantity they have, they're basically releasing it in the market. So two people are producing debt. The government is producing debt to finance deficit, and so is the central bank, because the private sector has to refinance it. So their basically net purchases are about $2.1 trillion, which means that the market had to absorb about $1 trillion of debt above the US deficit just produced, but released back to the public by the Fed. Now, who's not buying it? Well, it's the foreigners. In case you didn't know how the world functioned up to a couple of years ago, it was really simple. United States spent more, consumed more than it produced, which basically caused the other countries to have exports into the United States. Up to 90, that was mostly Europe. After 90, that was China. So basically, they financed their growth at the expense of United States consumption. But you cannot continue doing that. Someone has to give you money. So you finance the consumption through debt. And who bought that debt? Well, foreigners. Well, what haven't the foreigners been doing for the last couple of years? Buying US debt. Because if you look at the gray line here, the gray line is the recession, the COVID recession. So this is a 5-year chart. You look at numbers, it's 800 billion. So it's under 10% of the total amount. Also, do not be mistaken by this rise here. This rise is false. It's what we call that amateurs do in the market. They chase the yield. So they said, oh, the US is going to decrease their interest rates. I have to buy their bonds because now they're giving good yield, which was clearly a mistake. So the supply of debt is the quintessential problem. Because the supply of debt, for example, if you look at 2 years, is $4 trillion. It's $2 trillion annually just out of deficit. And then you have the QT, which is 300 this year, and at most it can be at 420. As you shall see, the QT has to stop. The QT in the United States will stop in a couple of months. They know it has to, and we're going to explain why. So the question that we're asking ourselves is, why aren't the bonds collapsing? If you are producing so much debt, and you're releasing so much debt into the market, you know, the supply and demand thing, why haven't the bonds collapsed? There's several reasons for it. Number one, well, initially when they started producing debt, you had a lot of room to buy. Secondly, we saw that last couple of quarters, there was a chase for yield. But thirdly, why it is not collapsing is basically this. This is, again, a quarterly map, last 5 years. And this is non-financial corporate business debt in the United States. So this is all the debt that corporations have. And what do you see for last 2 quarters, 3 quarters? The debt is not rising. As a matter of fact, over the course of last quarter, the debt is decreasing, meaning the companies are deleveraging, which means that there's less production of corporate debt, which opens room for government debt to fill in. So that is what's going on right now. The companies are getting less money, meaning they're going to have less investments, and that is creating a false picture. There's not a problem with that. You can just sell it. You can sell it because there's no production here, which down the road in 2 to 3 quarters is going to be a decrease in investments in the United States. And you had that amateur chase for yield. Now, the simple truth is, you basically cannot solve a problem of inflation with monetary policy, because it's not a monetary policy problem. It used to be for a while, but it's not anymore. What we have now is what is known as structural inflation. To put it simply, structural inflation is caused by an inefficient economic system. Now, there's something that economists call frictions, which is exactly like in physics, frictions, meaning things don't function well. You have extra cost, extra charges, and whatever. Well, over the last course of 40 years, those frictions have been disappearing, literally like this. Because of globalization, trade was simple. Technology made communications easier. So everything became more efficient. That's why inflation was so low. Well, now you have a reverse process. The reverse process is that you have deglobalization. And those frictions are increasing. Because of your frictions are increasing, they're causing a certain level of inflation. And under that certain level of inflation, you cannot go. And this is why disinflation has stopped. You have the CPI in US has pretty much been flat for 7 to 10 months. You have that inflation in Spain has gone down to close to 1.5%. Now it's back up to 3%. Well, but we just saw an increase in interest rates, decreasing quantity of money. So how come we don't have disinflation even more? Because it's not caused by monetary and fiscal policy. It's caused by the global system itself. Since it's caused by the global system itself, you have structural inflation, which you cannot decrease. Now, obviously, is there a solution to structural inflation? Of course there is. Second thing that we have is a liquidity problem. Now, what central bankers will say is that banks are highly liquid. No, they're not. Banks are illiquid because the central bankers don't know how to measure banks' liquidity. They measure banks' liquidity the same way you measure your liquidity. So if I asked you how liquid you are, you would pull up your cell phone and say, I have X amount of euros on your account. That's not how banks look at liquidity. Because the central bankers never worked in a bank, they don't know how to measure banks' liquidity. Banks look at their liquidity in terms of inflows and outflows. So bank says, okay, this is how much money I have on my account, these are my inflows, and these are my outflows. So let's do the outflows. If you are a bank, you know two things for certain. Thing number one, you have to fund the government. Look at the deficits number. Thing number two, Central European Bank and Fed are conducting a QT. They're taking away your liquidity, which means that this year in Europe, you will lose €1 trillion through decrease of quantity of money, and you need another 700 billion to finance deficits. So when a banker says how much money I have, it doesn't look how much it has. It looks how much it needs. And there isn't enough. So how do you get money in a situation like this? Again, the wrong answer is, well, the banks are going to collect more deposits. No, because all the banks are on exactly the same side. So you cannot collect more deposits since everyone else is collecting more deposits. So how do you get money? You get it from the real economy. You force economy to deleverage. And everyone will say, this is such a great idea. We're decreasing corporate debt. You know who did that? And you know with what effect? Croatia, 2009, 2014, with 6 consecutive years of GDP decline. No other country in a normal economic situation has had 6 consecutive years of declining GDP, including Greece. So, as you can see, the quantity of money, the monetary aggregates, are decreasing. And now, if you want to do liquidity, because of inflation, you have to do something else, which is calculate everything in real terms, which is adjusted for inflation. So if you take this number here and this number here, and you discount it with inflation, you should actually discount it with nominal growth, you will realize that you have less money than at the beginning of pandemic. European economies and American economy has less money in real terms today than it had 5 years ago, which means liquidity is smaller, which means your investments are going to decrease. So if you have a decreased investment, that's not that big of a deal. You can suffer through it. Except there's that one little comma. If you have a decrease in investment and innovation in a critical point in time, this is exactly like the 90s. This is exactly like the 20s or 60s. You have a huge technological investment through AI. In the 90s, you had an internet. If you don't adapt, others will go above you, which basically puts Europe, in terms of significance, global significance, within 10 years, it will be under Africa. Africa will be more economically and politically significant by China, Asia, US, Africa, and then Europe, because of what is going on. Now, let's do the Megadeth thing. The second album by Megadeth was Killing Is My Business and Business Is Good. Well, I used to be a professor of economics about 2 million years ago. Now I'm a bond trader. And bonds are my business, and business is good. You know why? I actually approve all of this. Because if you had someone who knows stuff running the European Central Bank, I wouldn't be able to make money. So the way things are, they're really simple. European Central Bank and European Commission are going to sacrifice you, your economic freedoms, and your welfare, and your economic growth in order to fulfill pointless goals. That's the game. I, on the other hand, as a bond trader, am going to do well. But there is a secret formula, which brings us to the end of why I said I'm working with the outlaws. Remember, when freedom becomes outlawed, only outlaws will be free.
Now we will move on to the price of enjoying the sun and sea, presented by Vedran Šošić from Croatian National Bank. The stage is yours.
So, hello everyone. My name is Vedran Šošić. I'm the Chief Economist of the Croatian National Bank. We heard that foreigners like coming to Croatia to enjoy the sun and the sea, but also to study. And I will show a little bit that this also has a bit of an impact on inflation, because Croatia has currently one of the highest inflation figures in the European Union, and currently the annual figures, the highest annual figure for in the euro area. But before that, I will not I will not discuss with everything that was said previously. I will just correct one technical mistake. When commercial banks buy government bonds, so when they finance deficit, it does not withdraw liquidity from the banks, it creates liquidity, because government is not keeping banks' reserves at the government's accounts. It is spending this money, this liquidity is running back into the banks, so banks have both reserves at the central bank and bonds that they can use to trade, to do repo arrangements in the money market, so that it actually can. Of course, we do look at inflows and outflows. There is a measure, liquidity measure called liquidity coverage ratio. And Croatian National Bank will publish next month a stress test based on the liquidity coverage ratio. So it's based on 30 days inflows and outflows, but we also collect data for different time horizons So we will do both shorter horizons and longer horizons, and we will show how different liquidity shocks have an impact on our bank. So don't take everything that was said here at face value, but I don't have much time. We should already be at panel. So with the story with inflation, it has slowed down substantially from the peak, but it has sort of stalled recently. It is not declined much, and it is one of the highest in the European Union. And also, if you look at core inflation indicators, so if you strip food, energy, if you strip volatile prices, it's still substantially above the target. So there is still some disinflation to go. So where does this inflation come from? First, what we like to do at the National Bank and at the ECB as well, we like to look at so-called moments. What is a moment? It's nothing strange, nothing complicated. It's very simple. So if you take an inflation rate, it tells you, the one that you look in the newspapers, it tells you what has been increase in the prices over the past year. So the last figure now, 4.8, is for March. So it tells you how much prices increased compared to March last year, the last 12 months. So it's like looking a little bit in your rear mirror. So the best way to look what is the inflation rate now is to look at the monthly inflation rate. So what was the inflation in March this year? However, if you look at the only monthly inflation figures, they're very volatile. So it goes up and down constantly all the way. And you can go wrong if you concentrate on just one. So what we do, we we take 3-month and 6-month averages. And this chart shows you this 3-month inflation rate. So last 3 months compared to previous 3 months, and last 6 months compared to previous 6 months. So these are 3-month and 6-month momentums. And what these momentums tell us is that inflation has fallen over the past 4 or 5 months in Croatia below or at long-term average level. So this is slightly above 2%. We are a converging economy, so although for the target for euro area of the ECB is 2%, we had over the past 20 years, we had inflation rate 2.3%, so which is slightly above what euro area had, and we are going to have slightly higher inflation. So inflation is already at the long-term average. If you look the current number, energy momentum energy is below the long-term average. Momentum is food, although the annual rate is still quite high at about 5%. It tells you that prices last year increased a lot. So, and this is captured by the annual rate. But now prices are no longer increasing, have been no longer increasing for a number of months now. And Neven likes to mention deflation, so he will probably agree with me on this one. But if you look at core inflation, so this is excluding food and energy, it has increased recently over the past few months, and it is momentum. So this is the red line, and it is above the long-term average. So what is the reason? It's not non-energy industrial goods. So the prices of goods are actually declining. I saw Mr. Bakic was here. He had a few posts on Facebook. He announced deflation on the basis of this data. But there is another component in core inflation, which is services. And we have recently seen a substantial pickup in the prices of services. So the services, apart from services, there is nothing special going on if you look at the most recent figures. So, and which services are increasing? With services, so we have seen that this is the services until early 22. Our services inflation has been more or less in line with the euro area, and then we have seen a divergence, and now we are at above the range of what can be observed in other euro area members. And what is the reason? The reason is catering and hotels, accommodations. So hotels and restaurants are the main sources of inflation now. So this is where the inflation rate is the highest. So why do we have? One reason is that labor demand is very strong, although we have seen some softening of demand, so less although the unemployment rate is still at the record low, companies report fewer vacancies, and companies report to us, except in construction, where we see still a lot of demand for labor. Companies demand that having qualified labor is no longer such a big problem for them as it was a few months ago. So we see some softening of demand, which is being transmitted to the labor market. So we also see some deceleration in wage growth. Wage growth was last year, it was if you look at gross wages, the growth was almost 15%. Now it came down a little bit, and we expect it to continue. And except some wage moderation, this is not yet captured in the data, this is only until the end, last year. What we also see having an impact on current inflation, declining import costs. So if you look at deflator of goods and services, it moved into the negative territory. So the import prices have been declining at the end of last year. So this is supporting the disinflationary process in Croatia, and also unit profits. We heard about greedflation. We did a research in the National Bank. What we saw is that companies tend to keep their margins stable. So when you have an increase in input costs, it increases the absolute amount of your profits, so the stable price margin policy. And also it increases the share of profits in GDP. But when intermediate costs go in reverse, so when we saw that your costs are declining, where the cost of your input, the prices of your input are declining, then profits are providing a buffer for inflation. We have seen these profits have been declining late last year. So this is something that is going to support this inflation process in the coming months. And one also encouraging sign is that we for the past 25 years, we had a very stable relationship between services inflation and goods inflation. So services inflation is typically somewhat higher than the goods inflation. If you look at that long run averages, you'll see that the level of inflation is higher. And there is this upward trend of services prices against good prices. And during the pandemic, what we saw, first rotation from services to goods, and then the relative prices of services declined. And now as demand rotates back to services, and we have seen this in Croatia a lot because the demand for tourism has been very strong, prices have gone back to the long-term trend. So I suspect that these prices are probably not going to increase much above this trend. So this is also another encouraging sign. So I hope I have explained a little bit about the inflation process. So the current moments are in line with historical averages, except for services, where it's driven by, in part, rising wage costs, but also strong demand. And these prices have reverted back to long-term trend. There is a risk, of course, if the demand for tourism is very strong, it can push prices up a little bit. But you have to make a difference between prices going up and inflation going up. If you look at I've shown this momentum for services. We had last summer, we had exceptionally high increase in services prices. So the current inflation this summer would have to be even higher than that in order to increase inflation. And I suspect that it will not happen. We have seen some moderation in prices of services. So if it is, so this is seasonally adjusted. So this is taking out the regular season. So if prices increase more than it is expected due to season, I suspect that the decline in inflation will continue over the next few months, regardless of this increase in the price level. So you usually in the newspapers you will read that inflation will increase. No, prices will increase, but inflation will go down. So thank you for your attention.
We've reached the round table with the topic of Bidenomics and Inflation, and I would kindly invite Barbara Kolm, Vuk Vuković, Neven Vidaković, Vedran Šošić, and Vedrana Pribičević to the stage.
All right, so the topic of our panel discussion is Bidenomics and Inflation, and I mostly kind of got this idea what we should be talking about is because I was looking at the guests of the conference that the central bank organizes every year in Dubrovnik. And one paper really struck my mind, that is Baro's paper on the effects of this huge government outlays in the last few years on inflation. And this is why we're talking about this now, because obviously the fact that inflation has returned big time, that now researchers are turning their eyes to the causes. So I will start with the first question to Mr. Šošić, because the public has kind of had the feeling that inflation comes with the Eurozone, entering the Eurozone. We kind of have these two mixed up. And now we have a situation where, fiscal policy in Croatia is under the influence of the elections, and then you have the monetary policy, the single monetary policy, and then, how confident are you that in the future fiscal policy in Croatia is going to be in coordination with common monetary policy?
Well, many questions in just one single question. First, I have to say that central banks are independent institutions, as Mrs. Kolm said. So,
supposedly.
So we don't like when an executive discusses how monetary policy should be run. And, the flip side of this coin is that we don't go around and and boss around ministries of finance telling them how they should run their fiscal policy. What they do with fiscal policy for us, we usually take as given, and then we try to adjust our monetary policy in order to achieve our primary goal, which is price stability. I will discuss a little bit fiscal policy, but maybe, if you feel that I'm a bit restrained, we always are like that. So we try to have, peaceful coexistence with Ministry of Finance, with each of us doing our part of the work and not interfering too much in the area of other institutions. Once we enter into the euro area, I mean, this changed because the ECB is not taking into account Croatian fiscal policy. Because we are too small country, our fiscal policy does not affect the economic activity and inflation in the euro area. So it does not adjust definitely. But still, fiscal policy is a key stabilization tool, a national stabilization tool that remains for stabilization of economic activity and inflation after we introduce euro. Although this is not such a big change, and Neven said that how referred to the policy of the National Bank in the past from 15 to 10 years ago, we had very few degrees of freedom even before we entered into the euro area. At that point, fiscal policy was supposed to be the main stabilization tool at that time as well, although it has not always played that role. Fiscal policy also used to be historically pro-cyclical. So now, what is the situation now? I would say that we are now in a much better situation. When we entered the EU, we immediately were placed into the excessive deficit policy. We had to do some huge budget adjustment. Now, last year we saw some deficits, very slight deficits, only 0.7% of GDP, which is not so huge. The year before 22, we had a very small surplus, and this year the balance is projected to deteriorate a little bit to 1.9. But the public debt remains on a downward path. So now it was 63% last year. Now it's expected to fall below 60%. At the peak, it was almost 87%, so substantial degree in the level or in the ratio of public debt to GDP. I have to be precise. So the ratio is declining. So this, I would say that this gives us a much better, more comfortable position now when we have entered the euro. Also, what we need to take into account is that the fiscal rules will be reinstated over the next weeks or months. The European Commission will be issuing country-specific some recommendations, and then also there will new fiscal rules will come in force probably during the course of this year. So these rules will also prescribe, because fiscal rules have been suspended during the pandemic. These rules will also prescribe some adjustment path for the Croatian fiscal variables. So this will also act as one way of this will stabilize. I guess it will should create a room for fiscal buffers to operate in the future in case we have a severe downturn. So I think that our position is quite good, and there will be definitely set guardrails to keep us from getting into the position that we need to run pro-cyclical fiscal policy again in the future.
Thank you. Since Vuk is a fund manager keenly looking to the US market, thank you for joining us. We know we're very busy.
Never too busy for when you invite me to.
Yeah. So, I mean, the Fed still hasn't cut rates really, and this affects us all. So how do you see this panning out? Why Fed hasn't cut rates? And, some people are saying that kind of Bidenomics has turned into Biden inflation along the way. How do you see this as somebody who's a hedge fund manager?
Thank you. Thanks for the invite, and happy to be here. So yeah, I mean, in the US, when we entered this year, when we entered 2024, the expectations was that we were going to have at least 150 basis point rate cuts. So going from 5.5, we're talking about US, to around 4, maybe even less. Now the expectations are maybe only one cut, so only 25 basis points, probably in September. That's the current rate of what the market expectations are. Maybe it doesn't happen at all. We'll see. A lot depends actually on what's going to happen next week with terms of, because I'm glad we talked about this interrelation between fiscal policy and monetary policy and how they affect each other, especially when, as you were mentioning, the debt levels are so huge, and you have so much bond issuance. So within that context, there's also, I've been following, because this is part of my job, every FOMC meeting and what their decision will be. And they were always data dependent, like every central bank should be, right? So it's data dependent, looking at what's happening. And as inflation was on a downward trend throughout last year, the confidence was high. Especially, but starting this year, we were starting to see this small uptick, right, in inflation, especially in certain. So, as Vedran showed in his presentation, I think like the situation across the EU and the United States, at least the markets that I'm following, is very similar. So we have food inflation and energy inflation are down. They're down to those like 2% levels, but services are up, right? Specifically in the US, it's housing, it's transportation. With Croatia, it's something else, right? But the thing is, like, as services are up, inflation tends to remain stickier than expected, which is, again, forcing the central banks to reevaluate their position on rate cuts. So in my opinion, because of all this, what we're going to see, we're probably not going to see substantial rate cuts, maybe like one, but my baseline is actually no rate cuts this year, so higher for longer, or as we say, no landing, right? There was these stories. Do you get a soft landing? So you get soft landing, hard landing, meaning you have to increase rates, and then as you cut rates, you do it because the economy goes into a recession. So you have a hard landing. Soft landing means you're able to lower inflation without creating a recession. Which is kind of the holy grail. No landing in this context is you keep rates high because the labor market is super strong, unemployment is at close to all-time lows, and the economy is growing. So in the US, the Q1 GDP is 2.9%, so that's high, right? So that means you're not going to overstimulate into an already very strong economy. That doesn't make a lot of sense.
Thank you. Neven, if I may ask, I was following some of your public appearances lately, and you talked about that governments can become dependent on inflation, right? That they kind of would you care to explain for our students what you meant by this? That governments and the government finances.
Okay. Let me tell you the secret truth. Like in comics, you have the secret origin. There are two books which few of us refer to as Necronomicons, the books of dark arts. They're written in the 80s by a guy who wrote about structural inflation in Yugoslavia. And this is exactly what is happening now in Europe. Europe is now in 1985 Yugoslavia. You have a change in the structure of the system. Once you have a change in the structure of the system, without being recognized by a fiscal and monetary policy, the system starts to disintegrate by feeding off of itself. So you have that, for example, the Croatian government says, oh, because of the inflation, the real wages have fallen. Since a lot of people are tied to government companies in terms of employment, we now need to increase wages in order to maintain the standard. But at the same time, the government projects that inflation will fall radically. So those two are in contradiction. So for example, let's say inflation tomorrow goes to zero. You still have all the promises of wages and salaries going up, pensions, which will create a deficit, which then you need to fund. So this creates kind of a loop system. And everything that, we've seen that it's now service inflation. Well, from 2012 to 2019, Croatia had a record tourist season every year. How come we didn't have inflation then? Because if you read those books, you clearly see which sectors prosper under structural inflation and which sectors have huge problems under structural inflation, which is basically manufacturing. Construction is a two-way street. It booms, then it goes down. Same thing with hospitality services. They boom, then they go down. So there's nothing basically new under the sun. And that is what is going on. And every single time, we're seeing the European Central Bank truly is a clock that's broken and correct twice a day. Because if you look at the 2% inflation like this, you put it on a graph, and then you put in inflation, it goes like this. So for 10 years, we've been listening, next year, we will reach the 2% inflation target. What are we listening for last 5 years? Next year, we'll reach the 2% target inflation. So the first 10 years was the bottom, and then the second year is from the top. There used to be a great entrepreneur from who ECB borrowed that phrase, a British entrepreneur. He would used to say, next time this year we'll be millionaires. So same time here, next time this year we'll have 2% inflation.
So maybe a comment from Vedran. I mean, the return of inflation has actually rekindled researchers' interest in what we call fiscal theory of price levels. So how is inflation actually related to public finance?
Well, it's as Neven says, it's a two-way street. How we usually like to look at it is first is this impact, which is called Olivera-Tanzi impact. At first, inflation has a positive effect on government budget. So there is this, because the expenditures are only indexed with some legs. So first there is an increase in revenues, very positive. And we have a paper by Banic, Pripužić, and Rebić from Croatian National Bank who showed that until now there was this phase of positive impact, and over the medium term, it's usually more of a negative impact that prevails. So that is something that should be taken into account. So that's between inflation and of course, I said it's a two-way street. So the fiscal stance also has an impact on inflation. We saw an increase in expenditures, but we saw a very large increase in revenues as well. So it's, these estimates of fiscal stance in real time are always tricky. I would say that the fiscal stance was roughly, in last year it was roughly neutral, but in a year I may change my opinion when we get the new data and when we do new estimates. Because what with wages? The wage growth was very similar in the public sector, in the private sector. What the government did last year was follow what happened in the private sector with about half a year lag. So it did not lead the private sector here in Croatia, it lagged the private sector. Now we have another round of increases. It was last month, but we don't have the data yet, so we don't know, because it was not a linear increase, it was a reform of the system. What's in the budget, we have an increase in expenditures of about 13% in the budget for wages, but this is about half of this, or probably more, a little bit more, is due to base effect, because last year there was an increase from July. So it increases the wage bill because now this will apply, higher wage will apply for the whole year. So in the budget we have wage growth, so the additional wage hike in the government sector of maybe 6-7%. But we have to see, there is a little bit of risk because there are some negotiations going on later, after the budget was adopted. So we have to see, wait for the data and see what happens. But still, the wage growth is going down. So last year I said it was gross wage growth was almost 15%. Now we expect it to be between 8 and 9%. So substantially, although real wages will increase, should increase because of lower inflation, almost as much as last year. So this is going, although still not compatible with inflation of slightly above 2 for Croatia, but it is going in the good direction. And you mentioned the fiscal theory of the price level. It takes a completely different view on the relationship between inflation and fiscal variables. So instead of looking at the budget deficit, it looks at debt, and it asks, so okay, what is the price level? So what is the real value of government debt that is compatible with the present value of all future receipts, government receipts, so how much can be financed in the future. So if the public perceives that the debt is too big, that it cannot be financed, it creates inflation and it reduces the real value of that. So the funny thing is that in this framework, increases in interest rate actually have a inflationary effect, because it increases servicing costs, it increases the debt, it triggers snowball effect, so it actually increases interest. So this is a bit contrary to how we see in the central bank, we see the effect of inflation, but we still, nevertheless, we are open to discussing different mechanisms. Actually, we have invited Robert Barro, who last year published a very nice empirical study for OECD, and who said that about half of the increase in debt during the pandemic period was financed by inflation, and the rest should be financed, is perceived to be financed via future rate increases. And it's not just Robert Barro, but we have also John Cochrane, who wrote a large book recently, almost 600 pages, on the fiscal theory of price level. So he explains so he's sorry that Milton Friedman is not alive, because he has this monetary theory now. It would be interesting to see what the Milton Friedman would say about this fiscal theory. But he managed to explain every historical inflation within the US, and not only in the US, via fiscal theory. But the problem is that this theory can explain any inflation, because it depends on the assumptions, on the future assumptions for debt, for deficit, for revenues, for expenditures, for interest rates. So you can always find such a combination of these variables to explain why the inflation is now. So it's not straightforward which assumptions you should take. So it's not, you can test it empirically, but it is not straightforward. So this is also a little bit of a critique. So we'll have a discussion. Unfortunately, we don't have this discussion already in Dubrovnik. It's in 2 months from now. So I would share with you the spirit of the discussion. So, but I'm looking forward to it.
Thank you, Vedran. I mean, Barbara, in your speech, you were. You said that, and all of us who are very keen on central bank independence have seen that central banks have expanded mandates, not only, as guardians against inflation, but also becoming some sort of a crisis panacea, guardians of stability. And then you have greening of monetary policy, which is the central banks kind of really expanding their saving role. How how did this happen? Did we vote for this? Whose idea was this?
We did not vote for that. And, you know, the European Commission has not been elected by any of us. Those guys in charge there have not been elected by us. Only the people in the European Parliament are elected by us European citizens. So, and when I say we and they, I mean the man on the street and the politician in Brussels. This has been, and why I've been warning against this mixing up of monetary policy and fiscal policy and all those interest policies that we've seen in Brussels. And again, Brussels is pushing for, you know, for certain policies because they need to finance an ever bigger bureaucracy and an ever bigger redistribution on the European level. And they also want incentives or create wrong incentives, I would say wrong incentives by greening the economy from top down. We want to green the economy from bottom up. We want private investors, private innovation to provide solutions and not financed via public money or via redistribution of the taxpayers. This would be my humble opinion on that. So, but let me come back to this addictiveness that we have seen from overdebtedness, because during unconventional monetary policy, when the interest rates were super low, and they have gone down ever since 2000, and after 2008, eventually below zero, and now we are finally back to a normalization. But I just can give you a number of Austria because I have it here. Since 2012, and our annual budget is about 75 billion to 80 billion, depending, sometimes even 83, but this is the overall Austrian budget. So we have saved over the last 12 years, since 2012, 43 billion of euros in interest. So this should tell you something why politicians did not put this money on the side. They, you know, since financing debt is so cheap, there was no incentive for them to reduce debt. And that is one thing. And the other thing that I also wanted to mention before, and thanks for pointing that out, with tourism and service industries, we have seen that from the very beginning of when inflation finally hit Europe, the Eurozone in 2018. We saw the first sparks in 2019, 2020, it really became strong. Tourism was also the first one, and service industries, plus transport industries, where we immediately saw the rise of prices, and then came energy as an add-on to that. Just a side note. And last point I would like to make, because the consolidated balance sheet of the Euro system in 2022 was 8.8 trillion. And a lot of this money has been paid back already in the last couple of months with the TLTRO 3, and it was 1.8 trillion that has been reduced. So we are reducing the balance sheets that we have built up with the EPI programs, but it's way too low and way too little. It's just 30 million per month, and that's actually nothing. It should have been much more, and now we have additional issues. So I just wanted to mention that as well. Sorry for being long.
I actually have a, you know, I was looking at the news, and this is a bit of an impromptu question, but it's really related. I was reading the news yesterday, I think. And it turns out that, if I'm not mistaken, the next-gen debt, which was issued, the countries have not yet, which was the first really time that the EU countries kind of jointly sold debt, if I'm not mistaken. We still haven't agreed on the revenue streams from the EU budget, how we're going to finance this. So, I mean, this is, I was quite surprised. I thought they figured this out beforehand. So if Vuk and Neven would like to comment as active.
I don't care about what the EU does, to be honest. Right. No, I mean, I'm sure it's an issue, but I don't really, I don't know what to say. Next question.
Neven.
You want to say something?
I mean, I had no idea there was no plan, and it was.
Even I, who do not read newspapers or watch TV, know there isn't a plan. So I don't know why you're surprised.
Right. Yeah. Okay. I mean, maybe a question for Vuk regarding the U.S. elections. You know.
Oh, that's better.
And since you are you have kind of a hobby, a very successful hobby of being a political economist.
Yeah.
I mean, how is this Bidenomics that has led to Biden inflation to some extent, right? How will this affect the outcome of the US elections? I mean, this is super important for Europe as well, right?
I would be careful, and I mean, I wouldn't be so sure that it's Bidenomics that led to inflation. That is kind of the narrative, but I would kind of challenge that. Because we've heard it today, there's so many things that have caused and impacted this inflation, right? And if you look at, yes, there was fiscal policy with the Biden stimulus checks, there were also Trump stimulus checks, so both of these administrations have added to the problem, basically, when you look at it from that perspective. But there was also structural issues, there were also, the recovery from COVID, which created enormous demand, and that's the thing. Like, so we during COVID, when everything was in lockdown, as soon as you get a recovery from lockdown, there's a spike in demand for everything, right? People are starting to get out again and spend. So that was the impact, right?
For services particularly.
For services in particular, right? Think about it like. It's a supply chain effect, and there's also, like, for example, if 100 people walk into a restaurant, throughout the day they all get fed, right? But if 100 people walk into the restaurant the same half an hour, a lot of them will be hungry, right? Because that's the crowding effect, and that was one of the reasons. But we also, obviously, there was the stimuli, the monetary, the fiscal, all of these things contributed. We talked about, you mentioned the Ukraine war. That did not obviously cause inflation, but it did amplify it, right? Because there was the energy impact on energy prices. So in terms of elections, what I'm looking at is not that specifically. I'm looking at the reactions of, again, fiscal and monetary policy, and will they pump the economy enough time for enough months before the elections to kind of help Biden's re-election probabilities. I mean, that's a possibility. So I just came from the States. It's a bit biased. I was in Texas and in Florida, so obviously, the pro-Trump sentiment is enormous there, right? You get a feel that, like, if Trump loses that election, it's not happening, or at least it's going to be stolen again, right? Again. Sorry?
Secession will happen.
Yeah, no. I mean, like, so people are going to be in open revolt if it happens, which is not good. So there's like this political problems that we have, the political polarization. So on the other hand, there's a lot of like narratives that, again, as I mentioned, like fiscal and monetary policy, are they going to be stimulative enough? And this is something that matters to me, to my bottom line, right? So we're looking at, as I said, next week you have the Treasury decision about bond issuance, you have another Fed meeting. So, is it going to be supportive? I thought that they were going to do a little bit of kind of, let's say, help the deleveraging cycle a little bit before, so that they can stimulate the economy in time. But it just keeps on going up and up. So in terms of political implications, that's what I'm looking at, right? So yes, there could be an effect. Obviously, if you're the administration, Trump is saying obviously he fires the Treasury Secretary. He's also going to fire Powell as the Fed chairman. So maybe they do have career concerns. This is like the bureaucratic career concerns that we all know about. But on the other hand, they are doing their job. Obviously, they can justify their actions. But yeah, it is an interesting time ahead of us. And in terms of who's going to win, no idea. However, from the sentiment, a bit biased sentiment, because it was Texas and Florida. But it looking like Trump.
It's looking like Trump.
There's an important point to make here about monetary policy. Two things. Since the dawn of time when Nixon abandoned the gold standard, every single US president, every single Fed chairman, and every single Secretary of Treasury said two things. Thing number one is we want the strong dollar, regardless of the position of the dollar, including when the dollar was at an all-time high in '85. And two is US debt is not in question, the ability to service it. Well, the world has changed. 2 months ago, Powell said United States is on an untenable fiscal trajectory. That is a sense-shattering statement. Second thing is, the Fed has completely abandoned inflation targeting. Whatever they say, when they're saying, oh, we want the inflation 2% in the long run, that's just paying lip service to the general public. If you're actually a monetary economist and you truly listen to Powell, he will make statements that have nothing to do with inflationary policy. And he will say things like, he basically revealed how he conducts monetary policy in a sentence that completely went unnoticed. He said, we see the neutral monetary policy as the Fed funds rate at the long-term inflationary expectations. Therefore, if you conduct monetary policy like that, then inflation rate is irrelevant. It's not even a variable. And Fed is moving away from inflationary targeting. It's going to allow higher inflation. And if you look at the Fed chairman's press conferences, he always tells the truth and always answers the question. The only time he didn't answer a question was when a newspaper asked him, has Fed become more lenient to inflation? He answered, we're committed to a long-term inflation goal of 2%. That's a wrong answer. The correct answer is, no, we're not more lenient toward inflation. And why is he doing this? He knows that he's basically will have to do a walker. And to do a walker, for those of you that are under 60, means you break the economy completely in order to stop stagflation, which is what Walker, the Fed chairman, did in the early 80s. So now he's basically telling the fiscal policy, literally, dude, this stuff has got to stop. And this is what is going down. And all of that is happening where the United States is losing its power. Someone mentioned about Taiwan. I'll tell you what happened to Taiwan. Taiwan will willingly join China, rejoin China by the end of this decade. And that will mark the end of United States global supremacy. So all of these processes are causing the system to change, increase frictions, and guess what? Structural inflation. Now, on a personal note, I would really like to make a longer presentation about this in a town that I really like, at an institute I really like, run by a great woman, preferably in Vienna. So you can invite me for a guest lecture whenever you want.
Thank you so much.
Nobody would dare pinch your iPhone. There it is. So, well, ladies and gentlemen, that brings us to the end of a fascinating occasion. Mate says that this is the 16th Free Market Roadshow. I think I've attended most of them. If you're my age, you know you can't really remember that long, but anyway, we'll try. And what I can remember about them is that this is certainly the most stimulating and informative of these free market roadshows that I've attended. The whole thing was organized by Barbara Kolm, Vedran, where is she? There she is. And young Mate Ćurić here, who did all the work from the side of Centar za obnovu kulture. I did absolutely nothing, which means that I'm even more pleased to be here. The first of those panels was fascinating because it went back to the basic principles, but from very different angles, the basic principles of why the free market is the best system morally and practically. And the second session, I think, was equally fascinating, first of all because it was technically extremely demanding for me, I can tell you, and also because I really enjoy, and this is my Anglo-Saxon background, I enjoy it when people disagree. it really makes everything much more interesting when you can have a stimulating and productive agreement and disagreement, ranging back and forth quickly and without any pomposity and nonsense. And so I think that all of you, I hope you students, have also enjoyed it, dare I say, learned a little about it, and also perhaps heard a little of how, I'm somebody who lives in Croatia, I much prefer to live in Croatia, but one of the things I think we do get better in the West is that people argue. They start from different points of principle, sometimes shared, sometimes different, but they argue and we have a really good, fascinating outcome. And as a result of that, we actually learn and absorb more. That seems to me almost the essence of what a university education should be about. So thank you all very much for coming, and let's hope that we're all here for a 17th session. Who knows?
Use this experience to fuel your aspirations. Be part of the change. Let's explore, learn, and grow together. Secure your spot now.